As we start Chapter 7, we're going to take a deeper look into these predetermined overhead rates and how they impact our product cost and especially our overhead. So a couple of things that we're going to look at is that cost flow process, and then we're going to get into journal entries. So some of you are going to love this chapter and some of you are going to hate it, depending on your view of journal entries. There's a lot of them. So first, let's remember that cost flow process. Everything, remember, from chapters 1 and 2, and actually any chapter we learn will be built upon. So make sure you keep those study guides as a quick reference. So when we look at that cost flow process, when we're looking at a product, we start with our materials. And as we start to add in our product cost, this gets assigned to work in process. From work in process, when that product is complete, it will get transferred to finished goods. And once we sell it, it goes to cost of goods sold. As a reminder, when any of our product costs are sitting in these three accounts, they are assets. It's not until they're sold and they get moved into that cost of goods sold account that they become an expense. This is going to be helpful when we start our journal entries. So let's look at some of those journal entries. Hopefully some of this is just a reminder and easy to remember for you. That first one, record that purchase of materials. We'll debit our materials inventory because this is an asset. It increases with a debit, and we're going to credit our accounts payable. That's a liability, and therefore it would increase with a credit. Once we then have our materials in our warehouse and they get assigned to a job, this is when we debit our work in process. Again, an asset account. And we're actually going to decrease that materials inventory, showing it's no longer available for other jobs. We also have to record labor that's assigned to a job. Now, we're talking about direct labor. In materials, we were talking about direct materials. Both of these are going to debit our work in process. And most likely for labor, we would credit a wages payable, creating a liability. They've done the work, we just haven't actually paid them yet. It's that other piece of the product cost, these manufacturing overhead, that indirect piece that creates some problems in our product costs. We're going to record two separate costs for manufacturing overhead. We'll record our actual cost and our applied cost. When we record our actual cost incurred, whenever you see that word incurred, that means it's actually happened. We need to record that. Your actual manufacturing overhead is recorded in an account called manufacturing overhead control account. It's a debit to this account, and this is any actual. If you recently took Accounting 102 at Harper, you'll remember that overhead account, anything on the debit side is actual. We may have called it something or just called it manufacturing overhead. This again goes into a little bit more detail, and we're recognizing this as our control account. So again, your manufacturing overhead, nothing's really changed. Your actual amount is that debit. We're just calling it a control account now. Our credit would be various payables depending on the situation. So it might be a payable, it might be pretty much anything else that happens that's indirect. We're talking about maybe using up some prepaid rent, looking at accumulated depreciation, prepaid rent maybe if that's indirect. So any indirect cost. You'll have to just read that problem, see what it's relating to, and credit the appropriate account. If we're applying our overhead, this is a different story. This is what's going into our job, what we're assigning to our job. This is where we're taking that predetermined overhead rate. We're timesing it by the actual allocation base, whatever they tell you it is, and that's going to get your applied amount to the job. When we apply our manufacturing overhead, it's a credit because our debit is going to work in process. And our credit will go to manufacturing overhead applied. This will always have a credit balance. And we'll get a little bit more into that in a few minutes when we go through an example. But I just wanted to make sure you're aware of those differences. So when you look at that manufacturing overhead account, typically we'll have two different T accounts now, one for the control account, one for the applied account, and our applied account is a credit. When our jobs are done, just as a review, come back here, it goes from finished goods to cost of goods sold. Or when actually I'm a step ahead. It goes from work in process to finished goods first. So let's record that process because those are both assets accounts. We're going to debit our finished goods because that's increasing. And we're going to credit that work in process, showing we've moved it out of that account. Hopefully then we're going to record that sale and sell these items. This is a two-step process. First, we have to record that cost of goods sold, which would then decrease our finished goods. And that second part is to actually record the sale. Usually we'll record an account receivable and a revenue. So that would walk you through that whole process in journal entries. Let's take a little closer look at that manufacturing overhead account. So again, we have our manufacturing overhead control account, and we have our manufacturing overhead applied account. Our control account only records debits and of actual amounts. You'll see the word incur. The manufacturing overhead applied account records that amount that we're putting towards the job, that predetermined overhead rate times your allocation base to get the applied amount that we credit and goes into work in process. Some companies do use just one T account and record actual as a debit, applied as a credit. But we want to make sure you're aware of both concepts, so we're going to look at this. At the end of the year, or periodically, to make sure that we make our amounts in cost of goods sold accurate, we have to look and see if we've applied enough overhead to our accounts. If we've under applied our overhead, that means we did not apply enough. Or if we over applied our overhead, which means we applied too much to the jobs. So I think this is a little bit easier when we look at numbers. So we'll go through an example with that, but I just want to make sure that you have a solid understanding of this first. So if we're looking at an account that is under applied, so we did not apply enough. To our jobs. For example, let's say we applied $490. Our actual costs were $500. We're going to close these accounts out by getting rid of both of those accounts. So if it is under applied, this is under, then we are going to debit our manufacturing overhead applied for $490. We're going to credit our manufacturing overhead control account for $500. But remember, we have to make sure that our debits equal our credits, and that difference is going to go to cost of goods sold. So if it's under applied, your cost of goods sold will be a debit. Now let's look and see what happens if it's over applied. I'll switch colors so you can kind of keep this straight. If it's over applied, that means our actual costs will make them, let's make them different numbers completely so that it doesn't get confusing. Let's say it was 1,000 and our over applied amount, we put 1,500. Therefore, when we're correcting that at the end of the year, again, we have to debit that manufacturing overhead applied. We want to get rid of that balance. We have to get rid of that manufacturing overhead control account, which is 1,000. But now you'll see we need to make our debits equal our credits always. So that means we need to credit our cost of goods sold. So if it's over, cost of goods sold is a credit. So that helps just kind of very simply go through that manufacturing overhead applied versus control, and what happens when we need to clean that up and make sure our cost of goods sold is accurate. Now sometimes, instead of just putting into cost of goods sold, we might have some of our overhead applied that's still sitting in work in process or finished goods or cost of goods sold. And if we can determine how much of our overhead is sitting in each of those accounts, then we can be a little bit more accurate. So first we're going to find the percentage of over under compared to the total overhead. So for example, if I went up to, we'll use this as an example here, my 490 versus 500, that gives me a $10 difference. So if I want to know, I would take $10 as my percentage over under compared to my total overhead, and that's what you applied to your job, so that's 490. So that should be, let me make sure I have my percentages correct. 2%, rounding a little bit. So then what I would do is allocate that percent based on these three areas. I have my work in process, my finished goods, and my cost of goods sold. So I would take the amount of overhead in each of those accounts, and they'll split that up for you, times it by that 2%, and then I would just make a much more accurate journal entry. So I'm still going to be debiting my manufacturing overhead applied. That again would be for the full amount. Credit that manufacturing overhead control account, again for the full amount. And then I'm going to debit or credit each of these accounts, that work in process, that finished goods, and cost of goods sold. It's going to be a debit or a credit based again if it is under applied or over applied. So just as a reminder, if it's under applied, I'm going to be debiting these amounts. If it's over applied, then I would be crediting these amounts. So hopefully I did not make that more confusing than it needs to be. But we'll go through a couple examples and show you what I mean here. So I did want to make sure we go through an example, especially with all these journal entries, because it might have been a while since you've done these. So let's go through this example. It's example 7-23 in your book. We're just going to go through the journal entries, and then we'll look, kind of take it a bit further than they want you to, because we want to make sure we look at that overhead account. So first part, journal entries. The first one is we're purchasing $30,000 of materials on account. They call this materials inventory. They're going to debit it for $30,000, and that credit's going to go to your accounts payable for $30,000. I want you to recognize some of these words. I issued supplies from our materials inventory, and I want you to notice some of the other words in here, like direct. If it's direct, they're going to tell you it's direct. Therefore, I know that number 2, when they're just talking about supplies being issued, since they're issued, that's probably the fact that I'm incurring some manufacturing overhead. So this is going to my manufacturing overhead control account. Because remember, the word issued means it happened, it incurred. Incurred is actual. We want to get that recorded. the amount was $1,500. Because it's supplies, it's decreasing my materials inventory. Let's look at number 3. If we're purchasing some materials on account, again, I'm going to stick that over here because it's exactly the same thing. Debit that materials inventory and credit our accounts payable. And this one's for $37,500. Number 4 says we paid for the materials purchased in number 1 and we used cash. So 4 is looking at number 1, and since that's $30,000, we're going to pay off that accounts payable and we're going to use cash. In number 5, it says we issued, there's that word issued again, issued some direct materials into the production department. That means we're starting to produce. That means work in process. So I'm going to debit my work in process and I'm going to credit that materials inventory. And it is $45,000. Number 6. Come over here. Again, we incur direct labor. The credit is to wages payable. They're being nice. They're telling you. Debit that work in process. Credit my wages payable. For $37,500. Number 7, it says I paid for utilities, power, maintenance, and other miscellaneous items. Because it's miscellaneous items, and these are all things that actually need to incur, we're talking about equipment, maintenance, and it says it's for the manufacturing shop. Because it says it's for the manufacturing shop, we know it is a product cost. And since it's utilities and power, this is going to go to our overhead account. We're going to then debit our manufacturing overhead control account. And we'll credit, it says we paid cash. And that cash was $42,250. All right, let's move on to number 8. Number 8 is saying I applied overhead. Applied means we have to do a little bit of work. It says it's 140% of our direct labor cost. So I'm going to have to go back, look for what my direct labor costs are. Here's in number 6, it told me my wages were $37,500. So I'm going to take $37,500. This is my allocation base, times that by my predetermined overhead rate, and know that I am going to apply $52,500. That's going to go into my work in process account as a debit, and the credit is to my manufacturing overhead applied account. And that last one, we're recognizing depreciation. Again, the word manufacturing is in there, so we know that that is a product cost. Anything that has depreciation and is used on multiple products is going to go into our manufacturing overhead account. And this because its actual cost is going to go into my control account for 7,500. And then the credit there, because it has to do with depreciation, is going to go to the accumulated depreciation account. We're going to look and see what that's for. It's for property, plant, and equipment. So that should walk you through all of these journal entries and give you kind of an idea, a starting point. But I really want to kind of take this problem one step further and look at those differences in the control account and the applied account. So looking at this from two different T accounts, we have our manufacturing overhead control, and we have our manufacturing overhead applied account. The only journal entry I have that regards the applied account is right here, and that's a credit for $52,500. If I look back and record everything that had the control account in it, I see one here for $1,500. I see one here for $42,500, and I see one here for $7,500. So I'm going to record each of those. The last one was $7,500. I should probably put them in order, which would be more accurate. It was $1,500, $42,250, and $7,500. That's going to give me a balance of $51,250. Now I have to determine what's going on here and how much did I apply that was incorrect. So I'm going to look at the difference. I'm going to find that difference is $1,250. And then I'm going to say, is it over applied or under applied? Because I did not apply enough, it's over applied. I applied too much to that job, so I'm going to have to fix that. To fix that, I'm going to debit that manufacturing overhead applied for the full amount. I'm going to debit the cost of goods sold to make that correction, and I'm going to, oh, no, that was wrong, because if I'm over applied, I need a credit. So delete that part. Credit cost of goods sold $1,250, because if I'm over applied, I need a credit. And then I'm going to credit that manufacturing overhead control account for the $51,250. I'm going to take this just one step further. I don't have enough information in this, but I want to just show you an allocation of the over or under applied and how that would work. So I again would take that, look at how I'm going to apply over under. And the first thing I'm going to do is find that percentage. What is the percentage I'm over or under applied? And it's 1,250. I'm going to divide that by how much I applied, and you get about 2.4%. About. Right? So then I'm going to go and look at what amounts do I have in cost of goods sold, in my finished goods, and in my work in process. And they'll have to give this to you, and I'm going to look at the overhead that goes into these accounts. I'm just going to make up these numbers just for an example so that we have something to show you. But know that in total it has to equal the full amount. I'm going to take each of those amounts then and times it by that 2.4%. Oops. And I'm going to get 40, 480. And I'm going to play with the numbers here because there's some rounding issues. Again, just so you can see what's going on. This should come down to the amount that I am off, the over-under that I'm off. So when I make that journal entry using the applied method, I take that manufacturing overhead applied. I'm again going to debit it for that full amount. But then when I'm crediting each of these pieces, I'm going to credit cost of goods sold, credit that finished goods, credit that work in process, each for these smaller amounts that equal my total over applied. And then I'm also going to credit that manufacturing overhead control account. So I just wanted to show you the difference there. If you can understand this, basically understand the manufacturing overhead control versus applied accounts and what to do with that cost of goods sold when they don't agree, and just a review of the journal entries, you'll have this chapter under control. If not, let me know and I'll help you through a few more things.